Hello, this is David Jensen with your May 15, 2023 Economic and Markets Update. The title of today's discussion is Markets Signal Bank Crisis is Increasing. First of all, if you like this presentation, please do give it a thumbs up and a list to your social media platforms where I post information. Okay, we have a mounting banking problem, and fundamentally at its root, the cause is fractional reserve banking. Our central planners have designed a banking system that uses debt currency. Every unit of currency that's in circulation starts its life as debt, and it utilizes a fractional reserve banking system. So the banks hold only a small fraction of what they owe to depositors in the form of cash deposits, etc. And he uses the rest of the money to gamble in the markets, and that's how the banks make their profits, through loans and speculating on prices of bonds and things of that nature. Now, we know fractional reserve bank systems will always fail because investors' investments aren't perfect, and at some point they will all decline in value. And the trick is to either get bailed out or to hope that your depositors don't find out about the problems that you have with the assets in your balance sheet. The banks, they hold less than 1% in the form of cash deposits, that directly hold less than 1% of cash deposits, either in notes, in the actual paper currency form, in deposits in their own accounts, or in deposits with other banks. So the deposits with other banks are quite questionable because you don't know the condition of those other banks are. Now, the Fed also holds cash equivalent reserves for the banks, about 3 trillion. But the banks can't pull that out for a couple of reasons. That amount of cash, if it is pulled as depositors pull their money out of the banks, it enters circulation. It doesn't sit on the Fed's balance sheet, and it has a price inflation impact because it starts to circulate and be utilized in the economy. It's not parked at the Federal Reserve. And the second aspect to this is the fact that it would give a hit to the bank earnings. A majority of the earnings this year is likely going to be due to these deposits held at the bank, and the majority of these deposits originated from basically a gift from the Fed, a bailout where the Fed invented quantitative easing and then printed money and bought speculative and questionable bank assets at par value, at book value, and gave the cash to the banks. But you see, the 3 trillion that sits on the Federal Reserve balance sheet that it holds for the banks generates about 150 billion a year in profits over that this year. So that would be a hit to the bank earnings, just as they are seeing problems in terms of their balance sheet. We know they have a $2 trillion hole in their balance sheet. We found it out recently. But they're also going to see an increasing impairment on their balance sheet due to default of the loans and other assets that they hold here as the economy precipitously unwinds from the spike in interest rates. We also, today, we have high inflation, over 5%. So the game of quantitative easing or money printing by the central bank to give to the banks, we can't do that again as in 2008. But we have this underlying problem here that the savers are still pulling their deposits, and it reveals the cash holding problem of the banks. What are they going to do? We started to see this distress here in September 2022. We know from this is a Federal Reserve Board of Governors report that they viewed in February. They released it to the public in April. And this internal review said that 722 banks in the States, now that's not bank branches, that's banking institutions, had lost in excess of 50% of their capital by September 2022. And that was just with about a 2.5% rise in the interest rates, that the assets had declined that much and impaired the banks that much. And we've now had a doubling, more than a doubling of rates from September through to today. And we don't know what the impact is, but we do know that 722 different banks had lost in excess of 50% of their capital back in September. The question is, what's the real number? But I think that the markets are starting to tell us that there's a problem here. The other problem that we're seeing here is that the Fed regulators last stress tested, in air quotes, the bank interest rate risk back in 2015. We can see here that they did it in 2013, a rise of 2.5% in 1 year. We've had 5.25% in 1 year, and then they looked at 2.5% in 1 year, and then a slowing up to 5.3% over the remaining 2 years. But you can see that after that, there was no review of the impact of interest rates. So they've ignored that, and yet now we have the Fed has increased interest rates at the fastest rate in 50 years, and we have, due to this inflation surprise. Now, the inflation surprise is a feature of Latin American fiat money systems, and we're now finding out it's a standard feature of all the fiat currency systems, that when they run loose money policy, as the central banks have done now for 40 years, what happens in the end is that the debt is unbearable for the economy, so they have to inflate that away. And surprisingly now, as the debt has been run up to this tremendous level of $93 trillion, all of a sudden, once again, now in the West, in the US, Canada, Europe, etc., all of a sudden we have this inflation surprise and a spiking of interest rates. Now, the bank indices, this is what I was alluding to there with the market warning. The bank indices are warning us of a growing bank crisis. We can see the regional bank index for the regional banks in the US has declined by 50% since January 2022. So that was the peak there. And we're down here at less than 50% of the level at the peak in January 2022. And we've now had 3 weekly negative candles through to the end of last week. And that looks like it's an indicator here of an incipient increase to the downside. We'll see how the next following week goes, but that's the regional bank index. Now in the BKX, which is the broad banking index, including the biggies, Citibank, Bank of America, JP Morgan, as well as the regional banks, they've also decreased by a little bit greater than 50% since the beginning of 2022 through the end of last week. And we can see here they also have 3 red candles, weekly candles here, indicating that there's again, as I mentioned, an incipient leg down here. It appears. We'll see how that progresses. Now, this is a longer term look at the BKX bank index, and we can see here that they had a loose monetary policy here since 08, increasingly loose, and we can see now this leg down here in the bank index. It's heading down to this prior crisis level here that it hit back in 16 and in 2020. But anyways, we see this downturn here legging down. It's interesting on this lower panel here. We've got the yield curve, and this is a differential here between the 10-year and the 3-month. And we can see that when it's hit this, what they call a recession level, roughly of about negative 0.25%. So the 10-year Treasury minus a yield, 10-year Treasury yield minus the 3-month Treasury yield, when that goes slightly negative, it's an increase, an indicator that there's a recession about to hit, and the banks loosen the monetary policy. In an effort to avert the recession. We see here also that this negative yield here in the differential between the two again occurred back in 2019. So in August, September of 2019, we started to see this same type of yield curve inversion with a negative yield between the 10-year and the 3-month. Well before COVID hit, and now that has spiked down to a tremendously negative yield here, running approximately negative 1.75%. So that appears to be presaging here a precipitous drop in the bank in the bank index that's coming up here. We've never seen anything like this before. This type of negative yield curve that's happening at the present time. What has caused that? What has caused that tremendous inversion here in the yield curve? Well, what we saw here was in 2021 that the Fed had increased the year-over-year M2 money, which is a measure of the money in the economy, by 27%. And over 2 years, from 2020 to 2022, it increased it by 42%. And that is what is driving the goods price inflation spike, and then the consequent response of interest rates spiking. So there's your inflation surprise. Wild money printing by the Fed driving through to inflation in the economy, a devaluation of the currency, and then a spiking of interest rates. But the problem that we have here is that with the $93 trillion of total debt in the U.S. economy, the spike now to 5.25% from zero in about 12 months is with time going to drive $4.5 trillion of added interest payments into the U.S. economy, and there's no way that the economy can sustain that level of added debt burden. Also interesting to note here in the 1970s, here's 1980, but in the 1970s you can see how loose the Fed ran the monetary policy, and we know the consequent run in inflation at that time. Now they reduced it over a broad period to a somewhat lower steadily rate, but very erratic in the way that the Fed has managed interest rates here. The TMS, the true money supply, which I don't have a graph of here, but it gives even a better vision there of what the Fed is doing. But the Fed had been running steadily high interest rates relative to what had happened just previously back in the 90s, where it had tightened up quite a bit. But then this wild spike here in money printing has led to the price inflation of today. It drove the markets bananas in 2020 through 2022. But now you can see the Fed is greatly tightening M2 into the negatives. And we're going to have a precipitous decline now in markets. And I think in bonds as well. A lot of people are calling for a drop in interest rates. And there will be on the front end of a crisis, but everybody can see the money printing that the Fed has done to date, and they know that there's going to be more in a crisis. And the problem then is who wants to hold a currency which is being printed by these wild-eyed central bankers. So a final couple of notes here as we end 110 years of monetary central planning. Don't delay your personal preparations for this. In terms of assets out of the financial system and living in an area with good people and preferably with a low population pressure. And this really here is a metaphor. This guy here in the back wasn't much behind, less than a second behind the surfer in front. And even though he was on the same wave, he didn't act quickly enough, and I would like you to keep that in mind. The final note here, I think it speaks for itself. And then we'll close out here once more. These are the social media platforms on which I post my information. And please remember to give the video a thumbs up if you enjoyed it. And I look forward to talking to you again here in the near future. Thank you.